Hello friends, welcome to this video on mutual funds SIP myths and reality. SIP systematic investment plan is a very hot topic in India. It is advocated by all mutual funds, their association as the right way of investing in mutual funds. The purpose of this video is to really examine whether that is the right way to do or there are alternatives possible. Welcome to this video. So what is the rationale for SIP as is usually advertised? And we all see these kinds of advertisements appearing in the name of practically every mutual fund in India, including its association. If you go to their websites, you will find FAQs, some narratives about why SIP is the way to go. And here are some of the major reasons. It shields investor from market volatility. 2. They perform relatively better than lump sum investments due to rupee cost averaging if markets are volatile. And of course, markets are volatile. So that makes sense for SIP. Remember, these are not my arguments. These are the arguments by mutual funds. And we will examine each of these arguments one by one. It is a disciplined way of investing. No one can time the market. When you invest through SIPs over 3 to 5 years, likelihood of loss reduces significantly. SIP always gives you good returns. SIPs shield investors from harm such as short-term volatility and impulsive reactions. SIPs for meeting specific goals is a wonderful idea as they provide power of compounding. We all know power of compounding, as your principal can rapidly grow because of the return, and as the return gets added to the principal, the return further gets calculated on top of your principal plus return, and that's how the eventual amount becomes very big. That's the argument in respect of power of compounding. We are going to examine all these individually, but before that I thought I'll speak about some basic principles in investing. So what are the features of any investment? One, you can't think of any investment where there is no risk. Every investment involves risk. All that we need to do is to recognize what kind of risk are we undertaking. Another very important feature of any investment, as it should be, is your ability to enter and exit easily. Liquidity. Ability to move into that investment, get out of that investment. Both are very vital. Third, the goodness and riskiness of an investment must be judged in the context of time. Let's take an example. When property prices go up, you would always say that, oh, this is not a good investment at this time. It doesn't mean that real estate is a bad investment forever. Real estate is a great investment at a certain point of time, and it's a bad investment at some other point of time. So the judgment has to be exercised in the context of when, what is the time at which we are making this assessment. The same logic applies to equity, bond investing, or for that matter any other investment asset class. Lastly, what we try to do as a feature of any investment is we try to focus on maximizing the return in the context of the risk that we are undertaking. So it's very important to understand the risk, and it is also equally important that we maximize our return. Now let's talk about a few points in respect of investment strategy that we typically follow or should follow. So one of the very important aspects of investment strategy is capital protection. We must ensure that our capital is protected. Capital gets protected when we buy assets at a right price. If we buy an asset at inflated prices, we are actually creating a risk about protection of our capital. In fact, our investment can get very easily eroded. So it is absolutely common sense that we must invest at a right price. Naturally, buying an asset at lower prices and selling them at higher prices is a very natural thing to do, and I'm sure nobody can debate on this. Third, very important aspect which is often forgotten is that we must exit from an investment from time to time or at least inculcate that discipline of exiting when there is exuberance in certain asset classes. Whenever there is an exuberance, whenever everybody is extremely positive about the future, that usually is the time when the markets turn lower and we need to take out a certain part of our money at least by booking profits. This is very important. Lastly, investment always involves application of mind. Investment is not about throwing darts in dark. It is actually about talking about probabilities and putting our money to work at the right opportune time. And therefore, timing is a very important aspect of any investment. Let us critically examine these arguments that we had seen earlier, which I had listed as the arguments given by mutual funds advocating SIP as the right investment route. But actually these arguments are really myths. Let's address those one by one. The first argument given is that SIP shields investors from market volatility. Let's address this issue. Market volatility, if it is on the higher side, markets are booming, it never concerns an investor. When markets collapse, the prices collapse, they always create a huge amount of anxiety in the minds of an investor. Now, if one simply calculates returns on one's investment at that time, one would realize that the returns have been low, or in some cases even they could be negative. Now, how does SIP shield an investor from market volatility? In fact, it actually accentuates the problem, because if the investor has been investing at higher prices in the past and now the market has come down, you have actually huge amounts of your investments would be now at a loss. How does it shield you? It is not like a derivative product which creates that shield. It only prompts you to say that, don't worry about the market collapse, and they will exhort you to continue to invest in that SIP. What kind of protection does it give to an investor? None. And as I mentioned earlier, SIPs make investors buy at high prices, and thus when the market collapses, they stare at even bigger losses. So instead of shielding the investor, the worry simply becomes bigger. One argument is that in volatile markets, SIPs perform relatively better than lump sum investments due to rupee cost averaging. Now, my argument is, why should we average by buying at higher prices? Can we not simply buy when prices are relatively lower and not buy when the markets are booming? That makes more sense. And in such a situation, these kind of investments which are well thought through will definitely perform far better than SIP. Also, volatility is not a problem. It's actually a great opportunity for investors. We need to understand that stock markets, bond markets, foreign exchange markets, volatility is their very nature, because there are so many participants. Everybody is trying to guesstimate about the future, and that creates extremes. Now, these extremes is not a problem. It's actually an opportunity for investors, and investors must learn to take advantage of it on either side. When the markets collapse, we should put our money to work. When the markets are booming, we should take our money out, rather than mindlessly putting money into SIP and then arguing in favor of averaging. Averaging doesn't make sense. The other argument which is given in favor of SIP is that it gives you a disciplined way of investing. Now, before we go further and debate on this, I must say that discipline is about saving. Yes, we must save every month. We should control our expenses. That discipline is agreed. But here we are not talking about saving. We are talking about investing. So what is the discipline in the context of investing? The discipline in the context of investing is not about investing every month. In fact, it is no discipline. It is just an instruction to a bank or to a mutual fund to take money from your bank account. Where is the discipline in this? Discipline in investing is really about understanding when to invest, when to divest, and when to stay away from the markets. That is what discipline is about. Disciplining doesn't mean that every month you invest some money. That's not really discipline. Discipline in the context of investing is different from discipline in the context of savings. Friends, one central idea to SIP is no one can time the market. In fact, in my view, the true financial education is about making investors aware about why markets behave the way they behave. Why do markets fall dramatically? Why do markets rise? Far more than what the fundamentals of the economy warrant. And in fact, they should be made aware how they can use it for timing the market. Instead, everybody is talking about this idea that no one can time the market. Unfortunately, there is an economic incentive to the asset management company, its employees, its advisors to promote this myth. They get rewarded for higher assets under management. So if you start withdrawing money from the mutual fund when the markets are running high, it actually will have an impact on their own incentives, on their bonuses, on the profits of the AMC. And there is no regulatory requirement either for the fund managers and advisors to disclose how much percentage of their own portfolio is an SIP. That will actually let the investor community know whether they are really following the diktat which they are giving to others, or they are doing something quite different. We need to know whether they themselves are timing the market, and in high probability they would be doing so. On the website of one mutual fund, by the way, where I also have my own account, I found in FAQ one argument that when you invest through SIPs over 3 to 5 year period, likelihood of loss reduces significantly. Now, what is this magic about 3 to 5 years? What is the rationale? In fact, let us take an example. Let us say that the markets collapsed at the end of the 5th year, but they were doing great. They reached an all-time high at the end of 4 years. Now, just to wait for the end of 5 years, if the investor were to wait, the investor would suffer from a massive loss, right? And in fact, the opportunity loss will be so bothering him or her that the person would curse himself or herself for not having stopped the SIP at the end of 4 years. So there is nothing mechanical about any such period. The issue is at what stage are the markets booming and what is the right time of exit, rather than just putting some number of years. It doesn't make sense at all. One more argument in favor of SIP is that it always gives you good returns. Now, this myth could take root in India because India is in a structural bull market. India is a growth story. India is unfolding. India is growing. And naturally, even if you were to go through lump sum investing or through SIP route, in either case, you're going to get positive returns. But people today are not equipped to understand that by going through SIP, how much is their opportunity loss? If they had timed the market entry by taking advantage of the right timing in the market, the returns could be even far, far superior to SIP. But because people can't decipher that, they are being taken advantage of, unfortunately. SIP would be a disaster in an economy where there are growth or other structural uncertainties or challenges. We have seen some other developed economies which have gone through a lot of challenges. Now there, SIP would be a disaster. You have to ensure that you make entry into the market and exit from the market. The next argument is that SIP shield investors from harms such as short-term volatility and impulsive reactions. We already talked about volatility, and in any case, short-term or day-to-day volatility does not pose any concern to an investor anyway, whether the investor times the market or whether the investor is in an SIP route. So short-term volatility anyway has nothing to do with SIP. So whether the market goes up today, goes down tomorrow, goes up the next day, how does it matter for an investor either through SIP route or by timing the markets? These timings that we are talking about are on the basis of a longer term horizon of the market, not on short term volatility in any way. In fact, these market cycles of ups and downs should be fully taken advantage of. It is not difficult. In fact, this is a skill that investors need to learn, and that's really worth it. That is really the crux of financial education. One more argument in favor of S.I.P. is that S.I.P. should be used for meeting specific goals as they provide power of compounding. Now, power of compounding is a financial concept which has nothing to do with S.I.P. Power of compounding is available even in situations, and it in fact works even better when I'm able to time the market and put my money to work at market bottoms. My compounding and growth will happen dramatically, much more than what S.I.P. can do. So we should not confuse the S.I.P. as a strategy of investing with the power of compounding. They are two separate issues. So it's unfortunate that S.I.Ps are being talked about as they are the ones with the power of compounding. They have nothing to do with it. Power of compounding simply means that you keep on putting your return also back into that particular market. Now that has nothing to do with S.I.P. as a strategy. So the other thing that we should always keep in mind is that we don't have to complicate our investing by trying to create buckets for different goals. Our goal is simple, that our capital, our principal should grow as fast as possible. If our principal grows well, we can take care of all our needs, all our goals. We don't have to say that, this is an S.I.P. for this goal, this is another S.I.P. for student education, this is the third S.I.P. for retirement. All this is completely complicating your investment. Our simple logic is that find out whether the time is ripe for investing or not. If we crack that, and that's again not difficult to crack, I have myself created videos on this in terms of timing the market. We should surely learn that art, and it's not very difficult to learn at all. We can master it very easily, and then we can ourselves easily burst this myth about what is called as an S.I.P. So as I conclude, here are a few suggestions. Learn to broadly time the market. It is not difficult. I have already created a separate video in my series of principles of equity investing. You can explore this timing aspect more there. I recommend smart S.I.P. That means when you know that the markets are already at the lower end. Again, I will create separate video in terms of how do you make judgment whether the market is on the lower end or on the higher end, because the index number per se may not tell us whether it's on the higher side or on the lower side. So I'll create a separate video for that. But what I mean by smart S.I.P. is that whenever the market is struggling at the lower end, every day we can actually invest in a scheme that we have chosen. And I recommend index funds rather than those which are actively managed by fund managers. So that's a separate topic again, for which I'll create a separate video. But my point is that when the market is actually struggling, that is the time when you can actually put money to work practically every day in small quantities and accumulate a reasonably good investment at that time. And when the markets turn, they can actually give you a substantially good return, and you can use a part of that to exit. So in my view, timing gives far better returns than a blind strategy of S.I.P., and it also protects your capital, because there is no point in investing when the markets are running very high. We should always invest when the prices are reasonable. And to be able to do that, we need to manage our mind, we need to manage our cash, but those are skills which are easy to master and they are not difficult at all. So don't be carried away by propaganda which actually benefits the AMC, its employees and advisors, and we don't realize that we already have an opportunity loss by doing something which is not the best thing to do. So lastly, investing is always based on thinking and not just throwing blind darts, which S.I.P. makes us do. Thank you so much for your attention. I hope this video helped you. Do subscribe to my channel so that I get motivated to keep on creating more and more videos. Thank you so much.